David, great to see you.
Thanks for having me, Melissa.
Part of this is prompted by the House's downward revision of where they see the 10-year yield ending the year, which is now 3.25%. So can you walk us through how you get to the 16.5% PE that you landed at?
Yeah, sure. Happy to do that, Melissa. So, yeah, so over the last several years, there's been a pretty strong correlation between interest rates and valuation multiples in the market. And as we've seen this year, as interest rates have risen and risen quite dramatically, that's had a pretty detrimental impact on the valuation in the market. So it's really just taking on the higher interest rate expectations and what that means for valuations. Now, I would say though, Melissa, look, we've had a 24% decline in the markets, but I also think it's important to think about the long-term perspective here. Valuations for the market are now basically in line with the multi-decade averages, and it does suggest that investors should expect pretty healthy returns from here, 8 to 10% over the next 10 years. So, yeah, it's a very murky environment, but I think taking the longer-term perspective is exactly what you want to do in this kind of environment.
There are some who might argue, David, that estimates should come down further and that we haven't seen downward revisions or at least downward forecasts from companies yet, and that we will surely see that when the next earnings season rolls around. And I'm wondering how you start to think about that, because if 16.5, it's the 20-year average PE, it's roughly the 10-year as well. And this year does not seem to be an average year when it comes to headwinds.
Yeah, so look, I fully agree that we're going to see downward earnings revisions. In fact, our earnings numbers for next year are 235 for the S&P. That's about 7% lower than the bottom-up consensus. But after a 24% decline in the market, I think investors are expecting at least some decline in earnings and don't really place a lot of stock in the estimates that are out there at this point. So I think investors are braced for it. Look, that doesn't mean that we couldn't see some. I mean, it certainly is a headwind for the market as part of the reason why we took our estimates down. But on trailing earnings, Melissa, we're at 220 or so. That's in line with the long-term average that we're trading about 16, almost 16 and a half times trailing earnings. That is the long-term average since 1960.
What's your top pick for sectors, David, going into year end?
So we've had a pretty long-standing call on energy. It has been obviously the best performing sector this year. I still think the outlook for energy looks pretty good, especially over time. There's no easy solution to these high energy, high oil prices. It's going to take time to get supply and demand back into balance. So I think that still makes sense. Look, obviously, if we have a recession, nothing's going to be immune, and energy will get hit also. But we also think it makes sense to balance that out with some defensive exposure, which is why we like healthcare, where valuations are still, I think, pretty reasonable relative to the market. Certainly, earnings will hold up much better than the market in a downturn. And I think a lot of the concerns around drug pricing are likely going away. Either they'll get resolved or they're going to move to the back burner.
David, thank you.